KPMG has said that the UK economy is unlikely to recover until 2023. This is the latest figures, saw quarterly GDP fall by 20.4%. That's the deepest recession on record and the worst of any G7 nation. Joining me to discuss the outlook for the UK economy is Andrew Sentance. He's a senior advisor at Cambridge Econometrics and a former MPC member and an experienced business economist. Andrew, great to chat to you. First and foremost, why is UK's GDP suffering more than other developed nations?
Well, I'm not sure we are. I think it's partly statistical. In other words, the way in which the Office for the National Statistics in this country has recorded the output of the education and health sectors in particular has added an additional bias downwards for the UK GDP. I think if you look at nominal GDP, which is money GDP, and the amount that people are spending, the amount that the economy is generating in money terms, it's down about 15%, which is very similar to France and Italy. Germany has been slightly less badly affected because its coronavirus experience has been much more modest than our country. But I think the UK is suffering along with its European counterparts. I don't think we're actually suffering worse than them.
So Cambridge Econometrics, where you're a senior advisor, wrote on Twitter that it's the manufacturing sector that's really going to struggle to return to pre-COVID levels, not until the end of the decade, in fact. I mean, how do you think the pandemic's likely to shape the economy in terms of sectors?
Well, I'm not sure manufacturing is going to be the worst affected part of the economy. It's the services sector that is most potentially adversely affected, particularly consumer services, which are, the things that people are doing and which rely on people mingling and therefore socializing. And those type of services are going to be probably the ones worst affected. Manufacturing is affected to some degree because people need to work together, and so social distancing needs to play its part. But I think the general proposition is that we are not going to return to the way things were before the crisis. I think most economists are agreed on that. Patterns of work, the way we travel to work, the way in which we interact with each other, these things are not going to return to the way they were. So we have to be prepared for a different type of economy. Some people call it the new normal, which will assert itself over the next year or two.
So in terms of the new normal, there was a study from the CEBR saying that permanent working from home could reduce the UK economy by £480 billion. I mean, that was just the headline. I know you're a proponent of flexible working. What are your thoughts on this report, and what's the new normal going to be for the output of the whole economy? Are we looking at a new normal that's going to be a diminished size in terms of GDP, or is this a new normal that will be just as strong as before, if not stronger?
Well, I think those CEBR estimates are not really capturing the whole picture. So in the short term, there may be some short-term negative impact from people working from home because they can't do things exactly in the way that they did. And there's a whole Pret economy impact that people are fretting about now. But once things have settled down, there are a lot of benefits to be had from a stronger working from home economy. First of all, we have there's the benefits from a more flexible and family-friendly environment which people can work in. Secondly, there's the benefit from cutting down on transport emissions because people don't need to travel so much. And thirdly, there is the benefit from the fact that we can do things in a more sensible way. We can be actually more productive. So I don't buy into this view that we have a negative from the working from home economy.
Now, UK house prices hit a record high today, according to the latest ONS data. One analyst who was quoted in The Guardian from Track Capital saying that this stamp duty holiday from the Chancellor is creating a risk of a house price bubble. I mean, are you concerned that this could be bubble-like in terms of the rise of prices that we've seen recently? And should we be concerned about when the scheme comes to an end in March of next year?
Well, I'm concerned because I think, the last thing we really need to do in these circumstances is just press the button and say, let's stimulate the housing market. If anything, the housing market was already overinflated before the crisis, and needs to sort of subside a bit. So the fact that the government has provided extra stimulus to the housing market is not good from a macroeconomic point of view. Now, you can be justified from a short-term perspective, but what it seems to have done is actually to create a short-term housing boom, which is not really very good. So I think the government should not be intervening in the housing market in the way that it has, and let the housing market follow the economy rather than trying to stimulate the economy via the housing market.
Now, there seems to be some disagreements in government over how to fund this recovery. We know there's been a lot of heavy expenses from the government lately to support this economy through the pandemic. And unsurprisingly, there's been Tory opposition to the possibility that the Chancellor is looking at potential tax hikes, partly on the wealthy. I mean, what's your sense of the best way to pay for some of these schemes that we've seen, like the furlough?
Well, if we look at government debt as a percentage of GDP, it's fluctuated between about 30% of GDP and 250% of GDP. And it's currently around about its long-term average, which is around about 100% of GDP. So I'm not worried about government debt and government borrowing. Obviously, the government needs to show that it's on top of its finances and is not letting a sort of Zimbabwean, Venezuelan type scenario to evolve. But I don't think they need to panic. And some of the press coverage recently has been rather panicky, saying government needs to raise 20, 30 billion, in extra taxes. I don't think that's necessary at all. We can wait for that. If we need to raise taxes in that way, we can wait for it. And so we've got plenty of time to sort out public finances. The main priority now is to get the economy going, and actually tax rises would work against that. They would actually stop the economy from recovering. So that's not necessarily a good idea.
So what do you think the Bank of England can do there in terms of monetary policy? I mean, we've heard from the governor, Andrew Bailey, who said that the central bank isn't out of firepower. I mean, interest rates are record low, 0.1%. We've got £300 billion worth of QE. What's the firepower that he's referring to? What should we expect next?
Well, Andrew Bailey is talking his book, isn't he? I mean, why would a Bank of England governor, really newly appointed, say that I'm totally out of firepower? But actually, The reality is he is. He is totally out of firepower. He doesn't have the capability that we had in the financial crisis when we could cut interest rates from 5% to 0.5%. He doesn't have the shock and awe policy, the ability to introduce QE when nobody was expecting it. So he is out of firepower. He's just not being honest.
All right, Andrew, on that note, thank you so much for your time and your answers as always. That was Andrew Sentance, Senior Advisor at Cambridge Econometrics and a former MPC member. Thanks so much for watching IGTV. I'm Victoria Scholar, and don't forget to follow us on Twitter. We're at IGTV, and you can subscribe to our YouTube channel, IG UK.